Federal Reserve has hit the pause button on interest rate increases, at least for now. For the first time in 15 months, the Fed chose not to raise interest rates last week. It comes as data shows inflation is cooling, but it is still high. This afternoon, our financial expert Paul Hood is here to break down what that means for you. Paul, good to see you like always.
Good to see you.
So what does this mean, the Fed's decision last week, decided not to raise interest rates? What does it mean for inflation going forward?
Well, what people have to understand is, imagine steering a huge cruise ship, and you got all these dials that do different things, and you know the economic policies and results of monetary policies, they make a change and see how much it goes one way or the other. And so right now inflation's running about 4%. Last month it was right about 5%. A year ago it was about 9%. So they've got to play this game of tightening the economy, but not to a point to where it makes too hard to get loans, because then it really goes over the top. So what they're saying right now is they feel like it's going in the right direction. They're not confident enough to lower interest rates, but we're going to put off raising interest rates. So the expectation is the gaps in between the changes are probably going to widen, and just let the economy adjust as it does.
You know, people hear this news from the federal government and they say, you know, it's so much better and stuff, but in reality, they're still going to the grocery store. They're still paying more. Yep. They're still paying more for everything. It's hard to get loans right now for, I mean, your houses are costing more. So what's your message to people? I mean, it sounds great from the federal government, but in reality, people are still struggling.
Well, yeah, and it is hard because the driver of inflation is the devaluing of the dollar and then shrinking of supply, which creates higher demand, which drives prices up. And so they play around with interest rates to put more money into the economy, take more money out of the economy. And so it just means that we really need to be more proactive on our own. I say it almost every week: create a budget, know where your money's going, and handle it. The challenge we have, though, is I think people still have a pretty good confidence. I think the best thing they can do is increase those gaps between changes, because right now you go get a CD, it's hard to get a longer term CD because they don't know what interest rates are going to be 6 months, a year from now, or buy a home and lock it in for 30 years. Banks don't want to do that because they don't know what the interest rate's going to be. So I'm hopeful that they've got things kind of smooth to where they don't have to make such dramatic changes, so that people can forecast, people can make decisions.
Well, speaking of those dramatic changes, they said that they may not raise it again, but they don't know, because stuff changes. So they meet again next month. Do you think they'll raise interest rates again? Or, I mean, what's your prediction? Yeah,
the expectation is they won't do anything. It's pushing it to more of a 90 to 120 day change is kind of what we're seeing. Because again, you need to allow the economy, because their changes are what's called a lag indicator. So they do this and then see what happens, and then do this and see what happens. And sometimes, they overcorrect and then they got to go back the other way. And that's kind of what's been going on. So I don't expect much change at all for a period.
All right. Time will tell, I guess.
That's right.
All right, Paul, thanks for being here. We appreciate it.
Thank you.
We'll be right back after this break. Stay with us.